the stock market is a continuously improving science. And in the old days, people used trailing PE, which had a very lousy correlation of 50%. This is not really predicting. It is just like a random, maybe you'll get it right, maybe you won't. But there have been improvements. The Shiller-Cape ratio, it was slightly improved. Maybe gamblers would consider this an advantage, an edge, just enough to win. But they come up with an even better one, the Q ratio. It's getting up to 0.7 correlation. It's still a bit dicey on the right side of the chart. And then we come up to the Buffett ratio. The Buffett indicator, maybe that's the reason why Buffett is one of the wealthiest billionaires on earth, because he was looking at the market value divided by GDP, but there's something even better now with a 91%, a 0.91 correlation. And this has to do with the average investor equity allocation and its ability to predict the stock market. Not only does it predict the stock market, it predicts it 10 years in advance, or at least it predicts the future returns of the stock market. And you can get all of that explained in this Philosophical Economics blog, the single greatest predictor of future stock market returns. Now, the equity investor allocation is this red line, and then the blue line is the reality subsequent 10-year returns of the stock market. And it is very close. It might be off by a year or two, but it is very close. You can't get a better prediction than this. 91% is amazing. And you know who keeps track of this data? The Federal Reserve. They're the ones who know what the stock market is going to do for the next 10 years. They don't bother with making daily predictions or monthly predictions, because those things are about 50% chance of going up or down. There's just no point in making those predictions, but they can make a 10-year prediction of future stock market returns. This is a Federal Reserve chart that actually shows you what this chart here is. This red line is actually the Federal Reserve's blue line here. And what it is the non-financial equities divided by equities plus debt, the world's debt. And it really tells you how much people have in stocks, a lot at this point here, versus bonds and cash, debt, and not very much here. So when the equities become a small part of investors' portfolio, they have the ability to convert cash and other non-equity assets into equities, which means there's a huge potential for stocks to go up, and they did. So at this point here, you could see in 2009, there was a huge potential for stocks to go up. In the year 2000, there was a huge potential for stocks to go the other way, down. So this is a very important chart to pay attention to. Now, looking at the chart, it doesn't tell you what your future stock market returns are going to be. So I took the calculations made in this made in this blog, put them into an app which is available on the Google Play Store. And you can see the stock market on this log chart stays within the bounds of the debt lines. It's shifted up and down to show the high and low range. And you can see the predictions here, the forecast. So when this magenta line was up here, there was a 91% probability that for the next 10 years, stock market returns would be near 16%. And now the magenta line is down very close to zero. At the most latest data, says the future stock market returns will be around 1.4%. That means the stock market's going to go sideways. It may go up a bit and down a bit, or it may go up a lot and down a lot, but over the next 10 years, stock market returns are going to average out the ups and downs until you just get sideways action for 10 years. If you're expecting to make a lot of money, I'm sorry. But if you don't have this chart here, you may be putting your money into the wrong assets. Maybe you should be putting it into something else rather than stocks. And this red line here shows you when stocks are expensive, and this green line shows you when they're cheap. It's the same chart as this, but this one here is logarithmic. So now you know how to get the most important information on the stock market very easy. And if you think this is a steep price for $100, well, you can uninstall the app after you see the data. You'll remember what's going to happen. Maybe you can take a screenshot. It'll last for 10 years. Compare the actual results to it. You'll see 91% probability it's going to be right. And there you have it, investors. Wish you well.